This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Three chapters from my book, Trend Following, my newest edition of Trend Following, my mega edition of Trend Following. Chapters 3, 10, and the epilogue. In my professional best audiobook format. And yes, there is a little bit of capitalist in me in the sense that I hope you like these 3 chapters presented free, and that you will actually pick up the audiobook. I think my narrator did a damn good job. Now, I'm in the audiobook some too, doing some interviews and stuff like that, but it was much easier to have a professional voice narration guy do it. So if you're wondering why I did not read the audiobooks, it's because standing in a studio, reading the sheets of paper, and to do it right, damn, that's some skill. I'm not sure I have that skill. I'm good at turning on the microphone and just going. But I don't know if I'm really good at reading my writing. It's so interesting, too, an unusual bipolar way. And I'm not sure how many of you out there have this experience, but recording yourself talking is one thing, and writing is different. Now, over time, they start to sound the same. People can read my writing and say, yes, that sounds like you, Mike. But in my mind, it's different. When you can see the written word and you can edit the written word, that's different than just riffing or just making it up on the fly. One of those inside baseball thoughts that some of you might have, just sharing from my perspective. So if you do enjoy these 3 audiobook chapter samples, please head on over to Amazon, head on over to Audible and pick it up. It's something like 30 hours. It's crazy. This audiobook is massive. But you know what? In an age of insanity, and we are in a massive age of insanity, cognitive dissonance, confirmation bias, it runs rampant 24/7. But in an age of that, I really strove to be timeless. I wanted something that endured. That's what my goal was with Trend Following. Be able to open it up a year from now, 5 years from now, 10 years from now, 25 years from now. And the only thing that would be missing? A current event, current data, but the principles endure. How much of modern life, all the riffraff you see on Twitter or Facebook, how much of that endures? We're literally in a moment right now where all of us are wasting our time listening to the emotional vacillations of lunatics. Absolute lunatics. It doesn't help us. It doesn't get us ahead. We've got limited time on this planet. It doesn't help us make money, but we're addicted to it. So in that spirit of insanity, today I offer a little tonic, a little salve, a little ointment to apply to your daily insanity. Something that is timeless. Without further delay, let me jump into chapters 3, 10, and my epilogue from my newest edition of Trend Following.
Chapter 3, Performance Proof. Even if you are a minority of one, the truth is the truth. Gandhi. What we've got here is a failure to communicate. Some men you just can't reach. So you get what we had here last week, which is the way he wants it. Cool Hand Luke. Anyone can tell you they have a successful method or system, but the only objective measurement is raw data. If a claim is to be made, it must be supported. The numbers in this volume, across numerous third-party reporting services and inside disclosures on file with American and international regulatory authorities, don't lie. You could be the skeptic and say, "Hold on, the numbers could be faked." That doesn't fly with decades of data across unrelated traders located in dozens of countries. This is not about one isolated Bernie Madoff track record open to hanky-panky. Thus, in reviewing legendary trend-following performance histories and assorted research studies I alone might own, my insider investigation methods are a whole other book, I zeroed in on 6 key data concepts: 1. Absolute returns, 2. Volatility, 3. Drawdowns, 4. Correlation, 5. Zero-sum, 6. Berkshire Hathaway. Absolute returns. An absolute return trading strategy means you are trying to make the most money possible. Author Alexander Anikin defines it succinctly. An absolute return manager is essentially an asset manager without a benchmark. Benchmarking can be viewed as a method of restricting investment managers so as to limit the potential for surprises, either positive or negative. Trend following in its purest form doesn't track or attempt to mimic any particular index, ever. If trend following had a coat of arms, absolute returns would be emblazoned upon it. It thrives and profits from the surprises benchmarking artificially stops. However, not all trend followers are shooting for absolute returns or the most amount of money possible. Not all play the game full tilt. Jerry Parker, for example, purposefully aims for lower returns to cater to a different client base, those who want less risk and less return. But John W. Henry long made the case that the overall objective is to provide absolute returns. Relative return managers, such as most traditional equity or fixed income managers, are measured on how they perform relative to some predetermined benchmark. We have no such investment benchmark, so its aim is to achieve returns in all market conditions and is thus considered an absolute return manager. Shoot for a benchmark in returns and you run with the crowd. Benchmarks such as the S&P might make you feel safe, even when that feeling is clearly artificial. Trend following, on the other hand, understands that trading for absolute returns and not from blind adherence to benchmarks is the best way to handle uncertainty. The concept of indexing and benchmarking is very useful in the EMT world of traditional, long-only, passive investing, but it has almost zero usefulness for an absolute return process. Again, it gets back to what it takes to achieve an absolute return. You need an enormous amount of latitude and freedom in executing a trading strategy to ensure capital preservation and achieve a positive return. At its core, the concept of absolute return investing is antithetical to benchmarking, which encourages traditional managers to have similarly structured portfolios and look at their performance on a relative basis. If you base your trading strategy on benchmark comparisons, it doesn't matter whether you are a talented trader or not, because all decisions are about the averages. Why is any trading skill relevant? It's not. That's why 80% of mutual funds don't beat averages. Volatility versus risk. There are organizations that rank and track monthly performance numbers. One organization gives a star ranking, like Morningstar. The quantitative rating system employed ranks and rates the performance of all commodity trading advisors, CTA. Ratings are given in 4 categories: A. Equity, B. Performance, C. Risk exposure, and D. Risk-adjusted returns. In each category, the highest possible rating is 5 stars and the lowest possible rating is 1 star. The actual statistics on which the percentiles are based as follows: 1. Performance, rate of return; 2. Risk, standard deviation; 3. Risk-adjusted, Sharpe ratio; 4. Equity, assets. Dunn Capital once received 1 star for risk, the implication being that an investment with Dunn is more risky. However, these rankings don't give accurate information on Dunn's true risk. This rating group uses standard deviation as their measure of risk. But this is a measure of volatility and not necessarily risk. High volatility alone does not necessarily mean higher risk. It's doubtful Dunn, with a track record exceeding 40 years, is overly concerned about being inaccurately penalized, but using standard deviation as a risk measurement does distort a true understanding. This same firm's ranking of then-active trader Victor Niederhofer demonstrates the star system's weakness. At the time of Niederhofer's public trading demise in 1997, he was rated as 4 stars for risk. Based on Niederhofer's past performance, the rankings were saying he was a much safer bet than Dunn. Obviously, the star system failed for people who believed Niederhofer was less risky. Standard deviation as a risk measure does trend following an injustice. One of my goals is to dispel the simplistic notion trend following is risky, or that all trend following strategies have high standard deviations, which means they are bad. A good illustration begins with this 10-year chart of various trend following performances. See Table 3.1a and b in the supplemental PDF. Just saying a trader is volatile and thus bad makes little sense if you examine absolute return performance. Table 3.1. Raw absolute returns should count for something far more than fear or career risk. They equal the only way to massive wealth. Nonetheless, volatility, what standard deviation measures, is still a pejorative for most market participants. Volatility scares them. Even when a young student can quickly analyze any historical data series to see volatility is normal and expected. But most investors try to run away from the hint of volatility, even when running is not possible. Some markets and traders are more volatile than others, but degrees of volatility are basic facts of life. To trend following, volatility is the precursor to profit. If you have no volatility, you have no opportunity for profit. The press is always confused, as seen in Business Week. Trend followers are trying to make sense out of their dismal recent returns. When you look past the superficial question of how we did, you look under the hood and see immense change in the global markets, says John W. Henry's president. Volatility is just a harbinger of new trends to come. Maybe, but futures traders are supposed to make money by exploiting volatility. Performance isn't a superficial question if you are among the thousands of commodity fund customers who lost money when the currency markets went bonkers. Focusing on one period in isolation while ignoring a complete performance history misrepresents the full picture. I wondered if this reporter had written a follow-up article correcting his observations about trend following, because the following year, trend trader Dunn produced a 60.25% return, and trend trader Parker produced a 61.82% return. It didn't surprise me. Business Week archives revealed no correction. Volatility. Hedge fund researcher Nicolas Meaden compared monthly standard deviations, volatility as measured from the mean, and semi-standard deviations, volatility measured on the downside only, and found that although trend following arguably experiences higher volatility, it is often concentrated on the upside, positive returns, not the downside, negative returns. Trend following performance is thus unfairly penalized by performance measures such as the Sharpe ratio. The Sharpe ratio ignores whether volatility is on the plus or minus side because it does not account for the difference between the standard deviation and the semi-standard deviation. The actual formula is identical, with one exception. The semi-standard deviation looks only at observations below the mean. If the semi-standard deviation is lower than the standard deviation, the historical pull-away from the mean has to be on the plus side. If it is higher, the pull-away from the mean is on the minus side. Meaden points out the huge difference that puts trend-following volatility on the upside if you compare monthly standard, 12.51, and semi-standard, 5.79 deviation. Here's another way of thinking about upside volatility. Ponder a market going up, You enter at $100 and the market goes to $150. Then the market drops to $125. Is that necessarily bad? No, because after going from $100 to $150 and then dropping back to $125, the market might then zoom up to $175. This is upside volatility in action. Even Harry Markowitz, see podcast episode number 235, who won the Nobel Prize for his mean variance theory, has noted semivariance is a better risk measure. He has even said he might not have won that Nobel Prize if he built CAPM around semivariance. Quite simply, trend following has greater upside volatility and less downside volatility than traditional equity indices because it exits losing trades quickly. Trend trader Graham Capital mitigates the fear. A trend follower achieves positive returns by correctly targeting market direction and minimizing the cost of his portfolio. Thus, while trend following is sometimes referred to as being long volatility, trend followers technically do not trade volatility, although they often benefit from it. The question, then, is not how to reduce volatility, you can't control the market after all, but how to manage it through proper position sizing or money management. You have to get used to riding the bucking bronco. Great trend traders don't see straight-up equity curves in their accounts, so you are in good company when it comes to the up and down nature of making money. John W. Henry sees the distinction. Risk is very different from volatility. A lot of people believe there is no difference, but there's a huge difference, and I can spend an hour on that topic. Suffice it to say that we embrace both volatility and risk, and for us, risk is that we're going to lose if we risk 0.2% on a particular trade. That is, to us, real risk. Giving back a profit to you probably seems like risk. To us, it seems like volatility. Henry's worldview didn't avoid high volatility. The last thing he wanted to experience is volatility that forced him out of a major trend before he could make a profit. Dinesh Desai, a trend follower from the 1980s, was fond of saying he loved volatility. Being on the right side of a volatile market was the reason he retired rich. Even with predictable and ongoing volatility debates, trend following has one of the longest-standing track records in the hedge fund industry and has consistently demonstrated its diversifying power. The ability to take short positions objectively is absolutely crucial. As a strategy with a relatively low Sharpe ratio, it needs to be well understood by investors, so the size of positions is in line with their particular risk tolerance. However, the skeptics and critics always view high volatility as only bad. For example, a fund manager with $1.5 billion in assets remains on the sidelines, refusing to believe in trend following. My biggest source of hesitancy about the asset class, trend following, is its reliance on technical analysis. Trading advisors do seem to profit, but because they rarely incorporate economic data, they simply ride price trends until they reverse. The end result of this crude approach is a subpar return-to-risk ratio. Another money manager opines, "Why should I give money to a Double-A baseball player when I can hire someone in the major leagues?" Looking at the absolute performance of great trend traders and calling it Double-A baseball makes little objective sense. I doubt this guy made it past October 2008 unless he was bailed out. Of course, the funds and banks that all blew out then were all considered major league. But if you can get beyond the volatility is the devil propaganda, it's easy to see how you can benefit from volatility. Trend follower Jason Russell says it well. Volatility matters when you feel it. All the charts, ratios, and advanced math in the world mean nothing when you break down, vomit, or cry due to the volatility in your portfolio. I call this the vomitility threshold. Understanding your threshold is important, for it is at this point that you lose all confidence and throw in the towel. Traders, portfolio managers, and mathematicians seem well equipped to describe risk with a battery of formulas and ratios they use to measure volatility. However, even if you can easily handle the math, it can be a challenge to truly conceptualize it. I can sum it up as follows. Surrender to the reality that volatility exists, or volatility will introduce you to the reality that surrender exists. Building on Russell's point, David Harding was asked, "You've attracted quite a lot of new money into the fund since you've launched, but particularly in the last couple of years. Why?" Harding replied, "The market has bought what actually is quite a complicated story. Our story is not simple. In our early years, we were impeded by the terrific performance of dot-com stocks. Later, people became very attracted to certain types of hedge funds, which produced very smooth and steady returns, something which we've never purported to do. But now that the story has been got across better, people are, I think, realizing that we are a good horse to back in the race." Drawdowns. With trend following, however, comes the inevitable drawdown. A drawdown is any losing period during an investment record. It is defined as the percent retrenchment from an equity peak to an equity valley. A drawdown is in effect from the time an equity retrenchment begins until a new equity high is reached. That is, in terms of time, a drawdown encompasses both the period from equity peak to equity valley, length, and the time from the equity valley to a new equity high, recovery. For example, if you start with $100,000 and drop to $50,000, you are in a 50% drawdown. You could also say you have lost 50%. The drawdown is thus a reduction in your account equity. Yes, that happens for buy and holders too, but the big difference is that trend following has an exit strategy built in. Not surprisingly, many investors and regulators have made drawdown for trend following a dirty word, while leaving mutual funds free to disguise their true drawdowns. Dunn Capital's retort: "Investors should be aware of the volatility inherent to our trading programs. Because the same portfolio risk profile is intrinsic to all programs, investors in any program can be expected to experience volatility similar to our composite record. During 40-plus years of trading, the composite record on a month-to-month basis has experienced 8 serious losses exceeding 25%. The 8th such loss equaled 40%, beginning in September 1999 and extending through September 2000. This loss was recovered in the 3-month period ending in December 2000. The most serious loss in our entire history occurred over a 4-month period, which ended in February 1976 and equaled 52%. Dunn did have a 57% drawdown in 2007, which it recovered from and made new highs as recently as July 2016. Clients should be prepared to endure similar or worse periods in the future. The inability or unwillingness to do so will probably result in serious loss, without the opportunity for subsequent recovery. Unless you understand Dunn's philosophy, you might refuse to invest, even though that 40-year-plus track record is the envy of Monday morning quarterbacks. Examine their drawdown history in Figure 3.1 in the included supplemental PDF. I use this same chart in Chapter 2 to illustrate performance, but it serves another purpose. Imagine the valleys between the peaks are filled with water. First, place a piece of paper over the chart, and then slowly move the paper to the right and uncover the chart. Imagine you have made a large investment in the fund. How do you feel as you move the page? How long can you remain underwater? How deep can you dive? Do you pull out the calculator and figure out what you could have earned at the bank? Do you figure out you lost enough to buy a vacation, car, house, or perhaps solve the hunger crisis of a small nation? To the eyes-wide-open player, this drawdown chart, Figure 3.1, is tolerable because of the absolute returns over the long term, but that doesn't make it easy to accept. An accurate discussion of drawdown inevitably leads to the recovery conversation, which means bringing capital back to the point where a drawdown began. Historically, trend following has quickly made money back during recovery from drawdowns. However, you can't neglect the math associated with losing money and making it back. What if you start with $100 and it drops to $50? You are now in a 50% drawdown. How much do you have to make to get back to break even? Table 3.2 in the included PDF. You need 100% to get back. That's right. When you go down 50%, you need to make back 100% to get back to break even. Notice as drawdown increases, see Table 3.2 in the included PDF, the percent gain necessary to recover to the break-even point increases at a much faster rate. Trend-following strategy lives with this chart daily. It handles the math. Table 3.2, Drawdown Recovery Chart. Size of drawdown, 5%. Percent gain to recover, 5.3%. Drawdown, 10%. Recover, 11.1%. Drawdown, 15%. Recover, 17.6%. Drawdown, 20%. Recover, 25%. Drawdown, 25%. Recover, 33.3%. Drawdown, 30%. Recover, 42.9%. Drawdown, 40%. Recover, 66.7%. Drawdown, 50%. Recover, 100%. Drawdown, 60%. Recover, 150%. Drawdown, 70%. Recover, 233%. Drawdown, 80%. Recover, 400%. Drawdown, 90%. Recover, 900%. Size of drawdown, 100%. Percent gain to recover, ruin. David Harding goes after drawdown haters. A key measure of track record, quality, and strategy riskiness in the managed futures industry is drawdown, which measures the decline in net asset value from the historic high point. Under the Commodity Futures Trading Commission's mandatory disclosure regime, managed futures advisors are obliged to disclose as part of their capsule performance record their worst peak-to-valley drawdown. As a description of an aspect of historical performance, drawdown has one key positive attribute. It refers to a physical reality, and as such, it is less abstract than concepts such as volatility. It represents the amount by which you are less well off than you were, or, put differently, it measures the magnitude of the loss an investor could have incurred by investing with the manager in the past. Managers are obliged to wear their worst historical drawdown like a scarlet letter for the rest of their lives. If the complete story of an absolute return trading strategy is understood, drawdown fear is mitigated. However, you can't eliminate catastrophic risk, much less drawdowns, from trading. A great example of getting scared at the wrong time during a drawdown can be seen in this trader's story. I once opened an account for a client. At the time, we were down 10 to 12%, and I explained the drawdown and our expectation for losses. Suddenly, when his account went down 20%, he became very anxious. He eventually closed his account. He made the business decision to stop trading because of the pain he was feeling from the drawdown. I continued to track his account hypothetically so I could see what would happen if he would have continued trading. He added, "As it turns out, he closed his account within 2 days of the drawdown low. Had he stayed invested, he would be up 121.1% from his closing value and 71.6% from his starting value through October 2008. I am reminded of a statement quoted many times from Peter Lynch, the manager of the Fidelity Magellan Fund. In light of Lynch's trading success, he revealed over 50% of the investors in his fund lost money. He explained the reason. Most investors pulled out at the wrong time. They traded with their gut and treated drawdowns as a cancer rather than the natural ebb and flow of trading. Interestingly, there is another perspective on drawdowns that few consider. When you look at trend-following performance data, for example, Dunn's track record, you can't help but notice certain times look better than others to invest. Some clients do look at that performance chart and buy when the fund is experiencing a drawdown. Because if Dunn is down 30%, and you know from analysis of past performance data that recovery from drawdowns can be quick, then buying while on sale is an option. This is commonly referred to as equity curve trading. Trend trader Tom Basso. I haven't met a trader yet that wouldn't say privately that he would tend to buy his program on a drawdown, particularly systematic traders, but investors seem to not add money when, to traders, it seems to be most logical to do so. Why don't investors invest on drawdowns? I believe the answer to that question lies in the investing psychology of buying a drawdown. The human mind can easily extrapolate 3 months of negative returns into how long at this rate will it take to lose 50% or everything? Rather than seeing the bargain and the positive return to risk, they see only the negative and forecast more of the same into the future. Not only do some trend followers tell clients to buy into their funds during a drawdown, they also buy into their own funds during the drawdowns. I know employees at top trend following funds who are too happy when they are in a drawdown because they can buy their fund cheap. Other trading styles have drawdowns too. For example, some of the best names on Wall Street, non-trend followers, had tough sledding in 2008, but they don't have the drawdown stigma associated with trend following. Warren Buffett, Berkshire Hathaway, negative 43%. Ken Hebner, CMG Focus Fund, negative 56%. Harry Lang, Fidelity Magellan, negative 59%. Bill Miller, Legg Mason Value Trust, negative 50%. Ken Griffin, Citadel, negative 44%. Carl Icahn, Icahn Enterprises, negative 81%. T. Boone Pickens, down $2 billion since July 2008. Kirk Kerkorian, down $693 million on Ford shares alone. It is paramount to determine how quickly you can recover from a drawdown and get back to making new money again, regardless of trading strategy. Correlation. Correlation comparisons help to show trend following as a legitimate style and demonstrate the similarity in strategy used among trend followers. Correlation is not only important in assembling the portfolio you trade, but it is also a critical tool for analyzing and comparing the performance histories of trend followers. In a research paper titled Learning to Love Non-Correlation, correlation is defined as a statistical term giving the strength of linear relationship between two random variables. It is the historical tendency of one thing to move in tandem with another. The correlation coefficient is a number from -1 to +1, with -1 being the perfectly opposite behavior of two investments. For example, up 5% every time the other is down 5%. The +1 reflects identical investment results, up or down the same amount each period. The further away from +1 one gets, and thus closer to -1, the better a diversifier one investment is for the other. But to keep things simple, another description of correlation is instructive: the tendency for one investment to zig while another zags. Let's look at an example. I took the monthly performance numbers of trend followers and computed their correlation coefficients. Comparing correlations gave the evidence that trend followers trade typically the same markets in the same way at the same time. Look at the correlation chart, see Table 3.3a in the supplemental PDF, and ask yourself, why do two trend followers who don't work in the same office, who are on opposite sides of the continent, have the same 3 losing months in a row with similar percentage losses? Then ask, why do they have the same winning month, then the same 2 losing months, and then the same 3 winning months in a row? The relationship is there because they can respond only to what the market offers. The market offers trends to everyone equally. They're all looking at the same market, aiming for the same target of opportunity. Table 3.3b in the supplemental PDF also shows trend followers using similar techniques. Interestingly, correlation can be a touchy subject. The Turtles were all grateful to Richard Dennis for his mentoring, but some were ambivalent over time, obviously indebted to Dennis, but struggling to achieve their own identity. One turtle says his system is 95% Dennis's system and the rest his own flair. I'm a long way from someone who follows the system mechanically, but by far, the structure of what I do is based on Richard's systems, and certainly, philosophically, everything I do in terms of trading is based on what I learned from Richard. Even when correlation data shows similar patterns among Dennis's turtle students, the desire to differentiate is stronger than their need to honestly address obvious similarities in their return streams. There no longer is a turtle trading style in my mind. We've all evolved and developed systems that are very different from those we were taught, and that independent evolution suggests that the dissimilarities to trading between turtles are always increasing. A turtle correlation chart paints another picture. The relationship is there to judge. The data, Table 3.4 in the supplemental PDF, is the ultimate arbiter. There is more to the story than correlation, however. Although correlations show turtles trade in a similar way, their returns differ due to their individual leverage and portfolio choices. Some traders use more leverage, others less. Turtle trader Jerry Parker explains, "The bigger the trade, the greater the returns and the greater the drawdowns. It's a double-edged sword." Zero sum. The zero-sum nature of many markets is arguably the most important concept in markets. Larry Harris, chair in finance at the Marshall School of Business at University of Southern California. Trading is a zero-sum game when gains and losses are measured relative to the market average. In a zero-sum game, someone can win only if somebody else loses. Harris told me he was amazed at how many people came from my websites to download his white paper on zero-sum trading, the topic left out of most strategy discussions. It's one winner and one loser. Harris examines the factors that determine who wins and who loses in market transactions. He does this by categorizing traders by type and then evaluating speculative trading styles to determine whether the styles lead to profits or losses. Winning traders can only profit to the extent that other traders are willing to lose. Traders are willing to lose when they obtain external benefits from trading. The most important external benefits are expected returns from holding risky securities that represent deferred consumption. Hedging and gambling provide other external benefits. Markets would not exist without utilitarian traders. Their trading losses fund the winning traders who make prices efficient and provide liquidity. There are those who absolutely do not accept that there must be a loser for them to be a winner. They cannot live with the fact everyone can't be a winner. Although they want to win, many do not want to live with the guilt by their winning, someone else has to lose. This is a poorly thought out yet all too common view of the losing trader's mindset. Harris is clear on what separates winners from losers. On any given transaction, the chances of winning or losing may be near even. In the long run, however, winners profit from trading because they have some persistent advantages that allow them to win slightly more often or occasionally much bigger than losers win. To trade profitably in the long run, you must know your edge. You must know when it exists, and you must focus your trading to exploit it when you can. If you have no edge, you should not trade for profit. If you know you have no edge, but you must trade for other reasons, you should organize your trading to minimize your losses to those who do have an edge. Recognizing your edge is a prerequisite to predicting whether trading will be profitable. Nobel Prize winner and co-founder of famed trend-following incubator Commodities Corporation, Paul Samuelson adds, "For every trader betting on higher prices, another is betting on lower prices. These trades are matched. In the stock market, all investors, buyers and sellers, can profit in a rising market, and all can lose in a falling market. In futures markets, one trader's gain is another's loss." Dennis Gartman adds to the perspective, "In the world of futures speculation, for every long there is an equal and opposite short. That is, unlike the world of equity trading where there needn't be equal numbers of longs versus shorts, in the world of futures dealing there is. Money is neither made nor lost in futures. It is simply moved from one pocket to the next as margins are swapped at the close of trading each day. Thus, every time there is a buyer betting that prices shall rise in the future, there is an equal seller taking the very opposite bet, betting that prices will fall." These observations will save your skin if you are willing to accept the truth. But as you can see throughout this volume, many are either ignorant to zero-sum thinking, choose to ignore it, or refuse to believe it, condemned to exist inside biases. George Soros. The trading success of famed speculator George Soros is well known. In 1992, he was labeled the man who broke the British pound for placing a $10 billion bet against the pound that netted him at least $1 billion in profit. Yet even successful pros sometimes miss a key point. Years back, Soros appeared on Nightline, an old-school ABC news program. This exchange between Soros and then host Ted Koppel goes to the zero-sum understanding, or lack thereof. Ted Koppel: As you describe it, the market is, of course, a game in which there are real consequences. When you bet and you win, that's good for you. It's bad for those against whom you have bet. There are always losers in this kind of game. George Soros: No, see, it's not a zero-sum game. It's very important to realize. Ted Koppel: Well, it's not zero-sum in terms of investors, but, for example, when you bet against the British pound, that was not good for the British economy. George Soros: Well, it happened to be quite good for the British economy. It was not, let's say, good for the British Treasury because they were on the other side of the trade. It's not. Your gain is not necessarily somebody else's loss. Ted Koppel: Because, put it in easily understandable terms, I mean, if you could have profited by destroying Malaysia's currency, would you have shrunk from that? George Soros: Not necessarily, because that would have been an unintended consequence of my action. It's not my job as a participant to calculate the consequences. This is what a market is. That's the nature of a market, so I'm a participant in the market. Soros opens a can of worms with his description of zero-sum. From a blog post that incorrectly analyzes Soros's interview, cosmetically, Koppel wipes the floor with Soros. He's able to portray Soros as a person who destroys lives and economies without a second thought, as well as simplify, beyond belief, something that should not be simplified. This is nonsense. The fact Soros is a player in the market does not establish him as a destroyer of lives. You might disagree with Soros's political ideology, but you can't question his morality for participation in markets. You have a 401k plan designed to generate profits from the markets, like Soros. Others, such as Lawrence Parks, a union activist, correctly state that Soros is in a zero-sum game, but Parks then goes jealous by declaring zero-sum unfair and harsh for the working man. Since currency and derivative trading are zero-sum games, every dollar won requires that a dollar was lost. Haven't they realized what a losing proposition this has been? What's more, why do they keep playing at a losing game? The answer is that the losers are all of us, and while neither rich nor stupid, we've been given no choice but to continue to lose. And every time one of these fat currencies cannot be defended, the workers, seniors, and business owners of that country, folks like us, suffer big time. Indeed, as their currencies are devalued, workers' savings and future payments, such as their pensions, denominated in those currencies, lose purchasing power. Interest rates increase. Through no fault of their own, working people lose their jobs in addition to their savings. There have been press reports that after a lifetime of working and saving, people in Indonesia are eating bark off the trees and boiling grass soup. While not a secret, it is astonishing to learn how sanguine the beneficiaries have become of their advantage over the rest of us. For example, famed financier George Soros, in his recent The Crisis of Global Capitalism, plainly divulges, "The Bank of England was on the other side of my transactions, and I was taking money out of the pockets of British taxpayers. To me, the results of this wealth transfer are inescapable." Parks says his only choice is to lose. He loses, his union loses. It's a pity party. It seems everyone loses in the zero-sum game, even though Parks' fund will of course have their assets invested in the very funds he criticizes. Look, there are winners and losers, and he knows that. Yes, the zero-sum speculation game is indeed a wealth transfer. The winners profit from the losers. Life is not fair. If you don't like being a loser in the zero-sum game, then it is time to consider how the winners play the game. Trying to understand Soros's reasons for denying zero-sum would be speculation on my part. Soros is not always the zero-sum winner either. He was on the losing side of the zero-sum game during the long-term capital management fiasco in 1998, in which he lost $2 billion. He also had severe trouble in the 2000 technology meltdown. With bets that went sour on technology stocks and on Europe's new currency, the 5 funds run by Soros Fund Management have suffered a 20% decline this year and, at $14.4 billion, are down roughly a third from a peak of $22 billion in August 1998. These wins and losses took a toll on Soros. Maybe I don't understand the market. Maybe the music has stopped, but people are still dancing. I am anxious to reduce my market exposure and be more conservative. We will accept lower returns because we will cut the risk profile. Don't blame zero sum. Longtime federal judge Milton Polak's ruling that dismissed class action suits illustrates zero-sum confusion. He minces no words in warning whiners about the game they are playing. Seeking to lay the blame for the enormous internet bubble solely at the feet of a single actor, Merrill Lynch, plaintiffs would have this court conclude that the federal securities laws were meant to underwrite, subsidize, and encourage their rash speculation in joining a freewheeling casino that lured thousands obsessed with the fantasy of Olympian riches, but which delivered such riches to only a scant handful of lucky winners. Those few lucky winners, who are not before the court, now hold the monies that the unlucky plaintiffs have lost, fair and square, and they will never return those monies to plaintiffs. Had plaintiffs themselves won the game instead of losing, they would have owed not a single penny of their winnings to those they left to hold the bag, or to the defendants. A 96-year-old judge bluntly telling plaintiffs to take responsibility for their own actions was no doubt painful for those seeking an incompetence bailout. Polak flatly nails the losers for trying to circumvent the zero-sum market process via the judicial process. The harsh reality of speculation is you only have yourself to blame for decisions you make with your money. You can make ongoing losing or winning decisions. It's your choice. David Drews, a longtime trend follower, takes Judge Polak's ruling a step further, spelling out the practical effects. Everyone who enters the market thinks they will win, but obviously there are losers as well. Somebody has to be losing to you if you are winning, so we always like to stress that you should know from whom you're going to take profits, because if you're buying, the guy that's selling thinks he's going to be right too. The market is a brutal place. Forget trying to be liked. Need a friend? Get a dog. The market doesn't know you and never will. If you are going to win, someone else has to lose. If you don't like these survival of the fittest rules, then stay out of the zero-sum game. Berkshire Hathaway. Amidst the recent celebration of Berkshire Hathaway's 50 years of investment returns, trend-following trader Bernard Drury and his firm Drury Capital wondered if a portfolio holding Berkshire, BRKA, already hugely successful, could nonetheless be improved by combining holdings of BRKA with other assets. An ideal candidate for investment alongside BRKA would be an asset with both positive returns on a standalone basis as well as low correlation to BRKA. In 1983, Dr. John Linter published the classic paper The Potential Role of Managed Commodity Financial Futures Accounts and/or Funds in Portfolios of Stocks and Bonds. In this study, he pointed to gains in risk-adjusted rates of return that potentially could be obtained by combining equity investment with managed futures. To examine a portfolio combination of stocks and managed futures, read Trend Following, Drury focused on Berkshire because of its legendary performance. On the managed futures side, Drury's Trend Following Fund satisfies the requirements of having both strong performance and almost zero correlation to Berkshire. While Drury cannot cite the same longevity as Berkshire, it has been in continuous operation for almost 19 years. At least for these years, it is useful to examine Drury in relation to Berkshire for a possible improvement of overall portfolio returns. The two performance records, taken individually during this period, are broadly similar. Table 3.5, May 1997 to February 2015. Drury and BRKA. Rate of return. Drury, 11.3%, BRKA, 10.4%. 50% Drury, 50% BRKA, 10.9%. Standard deviation. Drury, 20%, BRKA, 20.6%. 50% Drury, 50% BRKA, 14.4%. Drawdown. Drury, 32.5%, BRKA, 44.5%. 50% Drury, 50% BRKA, 23.9%. Rate of return divided by drawdown. Drury, 0.35, BRKA, 0.23. 50% Drury, 50% BRKA, 0.5. Rate of return divided by volume. Drury, 0.57, BRKA, 0.5. 50% Drury, 50% BRKA, 0.83. The correlation between the two return streams is 0.01. Despite the overall similarity of returns, the paths to producing these returns have nothing in common. Consequently, as modern portfolio theory would predict, the performance of a portfolio holding Berkshire is potentially improved by adding a non-correlated Drury. It is, of course, equally true a portfolio holding only Drury is potentially improved by being coupled with a non-correlated asset such as Berkshire. A look at the efficient frontier for this two-asset portfolio suggests a blend of approximately 50-50 would have produced the highest ratio of rate of return versus standard deviation of returns. The portfolio with 50% each in Berkshire and Drury raised the risk-adjusted rate of return to a level higher than either could achieve individually. For the holder of Berkshire, the diversification reduced the portfolio volatility by almost one-third and reduced the depth of the peak-to-trough drawdown by almost half. Finally, and perhaps even remarkably, the combination of Berkshire holdings with this non-correlated asset cut the length of the drawdown associated with holding Berkshire alone by a whopping 43 months. This means instead of experiencing a 61-month period, December 2007 to January 2013 underwater, relative to the latest high price, while holding Berkshire shares alone, the combined portfolio reduced the underwater period to only 18 months. By the same token, of course, the underwater period of holding Drury alone is reduced from 55 months to the same 18 months. Table 3.6, May 1997 to February 2015 drawdown, December 2007 to January 2013. Drawdown, Drury, 32.5%. BRKA, 44.5%. 50% Drury, 50% BRKA, 23.9%. Peak to trough, months, Drury, 32, BRKA, 14. 50% Drury, 50% BRKA, 10. Trough to peak, months, Drury, 23, BRKA, 47. 50% Drury, 50% BRKA, 8. Total, months, Drury, 55, BRKA, 61. 50% Drury, 50% BRKA, 18. Columbia University professor Benjamin Graham led academia and Wall Street with pioneering work across value investing. Famously, Warren Buffett was one of his students in the 1940s, and years later, the Nobel Prize-winning work of Harry Markowitz explored the effects of combining non-correlated assets to improve risk-adjusted returns. Markowitz is credited with the often repeated quip that diversification is the only free lunch in finance. Thus, it's not surprising that adding Drury's trend following as diversification to Buffett and Berkshire clearly enhances an overall portfolio return while reducing volatility. Ultimately, performance data is the driver, the only truth we can take in for analysis. If there is no data, no believable narrative can be used to explain anything. And trend-following data is a very clever way to illustrate human behavior with numbers, and it happens to also be proof of concept any skeptic would want before jumping into the deep end to deploy their risk capital. Yet where does trend-following performance data come from exactly? Summary food for thought. FU money. If you trade for absolute returns, you have the chance for FU money, the money it would take to leave your job and never work again. Ewan Kirk. When people ask, "What do you think is going to happen in the future?" we always say, "We don't know." We can't really project whether next year will be a good year or a bad year. Absolute return means trying to make the most possible. In a zero-sum game, the total gains of the winners are exactly equal to the total losses of the losers. George Crapple. So while it may be a zero-sum game, a lot of people don't care. It's not that they're stupid. It's not speculative frenzy. They're just using the markets for a completely different purpose, hedging. The U.S. Army War College introduced the acronym VUCA to describe general conditions post-Cold War: volatile, uncertain, complex, and ambiguous. Mark Rezepsinski. If a manager cannot explain what he does and his edge in 45 minutes, you should not invest. Bernard Drury graciously contributed for this section. Percentage change in stock price month over month as of each month end across the period covered. BRKA stock prices from Yahoo Finance. Note: you can review trend following performance going back decades. Send an email for online sources: www.trendfollowing.com/contact.
On to Chapter 10. I hope you enjoy.
Chapter 10: Trading Systems. If you don't risk anything, you risk even more. Erica Jong. No matter what kind of math you use, you wind up measuring volatility with your gut. Ed Seykota. To manage human fallibilities, trend following has a process to counteract behavioral risk. Psychologist Daniel Crosby lays bare in his Laws of Wealth where that success foundation starts: consistency, clarity, courageousness, conviction. Building on those 4 C's, trend following reduces to rules that guide daily decision-making. These rules comprise what are commonly called trading systems. There is no limit to the number of different types of trading systems, but most trend following systems are similar as they seek to capture trends in big liquid markets. Unlike so many holy grails, the never-ending fundamental predictions of this or that, trading systems are quantified. Dunn Capital, for example, has said their trading system has a programmed risk of a 1% probability of suffering a monthly loss of 20% or more. That's what I mean by quantifying. That's what serious people do. Risk, reward, and uncertainty. Trend following is a precarious balance between risk and reward. If you want the big rewards, take big risks. If you want average rewards and an average life, take average risks. Charles Sanford's commencement address nails it. From an early age, we are all conditioned by our families, our schools, and virtually every other shaping force in our society to avoid risk. To take risks is inadvisable. To play it safe is the counsel we are accustomed both to receiving and to passing on. In the conventional wisdom, risk is asymmetrical. It has only one side, the bad side. In my experience, and all I presume to offer you today is observations drawn on my own experience, which is hardly the wisdom of the ages, in my experience, this conventional view of risk is short-sighted and often simply mistaken. My first observation is that successful people understand that risk, properly conceived, is often highly productive rather than something to avoid. They appreciate that risk is an advantage to be used rather than a pitfall to be skirted. Such people understand that taking calculated risks is quite different from being rash. This view of risk is not only unorthodox, it is paradoxical, the first of several paradoxes which I'm going to present to you today. This one might be encapsulated as follows: playing it safe is dangerous. Far more often than you would realize, the real risk in life turns out to be the refusal to take a risk. One of Major League Baseball's best pitchers, all of 24 years of age, died in a 2016 boating accident. Jose Fernandez was almost guaranteed to make hundreds of millions of dollars, gone in an instant, perhaps due to a very bad risk choice. There is no getting away from that reality. There will be failure. Therefore, get over yourself and accept that life is a big league game of chance. And if life is a game of chance, assessing odds in the face of risk is goal number 1. Money under a mattress is no good. The house you purchase could burn down, or the real estate market might tank. Investing only in your startup is zero diversification. If your corporate job fails, you lose your employment and nest egg. Buy index mutual funds, pray that buy and hold will always work for you. That's dicey. There is no way to know what will happen next. To proceed in the face of risk, begin by accepting markets do not reward stupidity or ignorance in the long run. They reward brains, guts, and determination to find opportunity where others have overlooked and to press on where others fall short. Every business opportunity is ultimately involved in assessing risk. Putting capital to work in the hopes of making it grow is the goal. The right decisions lead to success, and the wrong ones lead to bankruptcy. Bear Stearns, Lehman Brothers, AIG, IndyMac, and so on. The key issues in a solid business plan. What is the market opportunity in the market niche? What is the solution to the market need? How big is the opportunity? How do you make money? How do you reach the market and sell? What is the competition? How are you better? How will you execute and manage the business? What are the risks? Why will you succeed? Those questions must be answered by everyone, regardless of venture or discipline. It is paramount to answer to assess the risk of a business venture, a relationship, and it is just as important to answer honestly if you are going to trade. Wise minds know the amount of risk taken in life is in direct proportion to how much you want to achieve. If you want to live boldly, you take bold moves. If your goals are meager, they can be reached easily with less risk of failure, but with greater risk of dissatisfaction. One of the saddest figures burns with desire to live big, but to avoid risk, embraces fear and lives lost. He is worse off than the man who tries and fails, or the man who never had desire. Yet there is hope. If you study risk, you will find there are two kinds: blind risk and calculated risk. The first one, blind risk, is suspect. Blind risk is the calling card of laziness, the irrational hope, something for nothing, the cold twist of fate. Blind risk is the pointless gamble, the emotional decision, and the sucker play. The man who embraces blind risk demonstrates all the wisdom and intelligence of a drunk. However, calculated risk builds fortunes, nations, and empires. Calculated risk and bold vision go hand in hand. To use your mind, to see the possibilities, to work things out logically and then move forward in strength and confidence is what places humans above animals. Calculated risk lies at the heart of every great achievement and achiever since the dawn of time. Yet when it comes to trading, most focus only on how to enter the market. They say, "I've got a way to beat the markets because this trading system I have is right 80% of the time. It's only wrong 20% of the time." They need to take a step back. Okay, what does 80% right mean? If 80% you don't win much, but 20% of the time you lose a lot, losses can far outweigh gains even though you're right 80% of the time. The magnitude of wins and losses is the game. Lotteries, for example, reach jackpots of hundreds of millions of dollars or more all the time. And as the jackpot gets bigger, more buy tickets in the buying feeding frenzy. But as they buy more, the odds of winning do not increase. The ticket buyers still have a better chance of being struck by lightning. For example, the odds of winning the California Super Lotto jackpot are 1 in 18 million. If one purchases 50 lotto tickets each week, he will win the jackpot about once every 5,000 years. If a car gets 25 miles per gallon and a gallon of gas is bought for every lotto ticket bought, there will be enough gas for about 750 round trips to the moon before the jackpot is won. If you know the odds are against you, don't play. Likewise, if your trading system says you have a 1 in 30,000 chance of winning, or roughly the same chance as being struck by lightning, you don't bet everything. You must have a mathematical expectation, an edge, or you won't win in the long run. For example, consider a coin flipping game. Imagine an unbiased coin toss game. Suppose also you bet that the next flip will be heads and the payoff will be even money when you win. You receive $1 profit in addition to the return of the wager. The mathematical expectation is 0.5 times 1 plus 0.5 times -1 equals 0. The mathematical expectation of any bet in any game is computed by multiplying each possible gain or loss by the probability of gain or loss. Then you add the two numbers. In this example, you can expect to gain nothing from playing this game. This is known as fair game. one in which a player has no advantage or disadvantage. Now, suppose the payoff was changed to 3-2, a gain of $1.50 in addition to a dollar bet. The expectation would change to 0.5 times 1.5 plus 0.5 times -1 equals positive 0.25. Playing this game 100 times would give a positive expectation of 0.25. This is the exact type of edge cultivated and honed inside trend-following strategy. You might ask, if everyone knows about expectation, how can I ever find my edge for success in the face of competition? Good question. Consider a scene from the movie A Beautiful Mind, the film biography of mathematician John Nash. Nash and some of his mathematician buddies are in a bar when a sexy blonde and 4 brunettes walk in. After they admire the new arrivals, Nash and his friends decide to compete for the blonde. However, Nash has reservations, correctly observing if everyone goes for the same woman, they will just end up blocking each other out. Worse, they will offend the rest of the women not chosen. The only way for everyone to succeed is to ignore the blonde and hit on the brunettes. This scene dramatizes the Nash equilibrium, his most important contribution to game theory. Nash proved in any competitive situation, war, chess, even picking up a date at a bar, if the participants are rational, and they know that opponents are rational, there is only one optimal strategy. That theory won Nash a Nobel Prize in economics and transformed the way we think about competition in both games and the real world. Building off Nash's work, Ed Seykota lays out a basic risk definition. Risk is the possibility of loss. That is, if you own a stock and there is a possibility of a price decline, you are at risk. The stock is not the risk, nor is loss the risk. The possibility of loss is risk. As long as you own the stock, you are at risk. The only way to control risk is to exit. In the matter of trading stocks for profit, risk is unavoidable, and the best you can do is to manage the risk. Risk management is to direct and control the possibility of your loss. The activities of a risk manager are to measure risk and to increase and decrease risk by buying and selling. In general, good risk management combines several elements. 1. Clarifying trading and risk management systems until they can translate to computer code. 2. Include diversification and instrument selection in the backtesting process. 3. Backtesting and stress testing to determine trading parameter sensitivity and optimal values. 4. Clear agreement among all parties regarding volatility and return expectations. 5. Maintenance of supportive relationships between investors and managers. 6. Above all, stick to the system. 7. See number 6 above. 5 questions. Answer the following 5 questions, and you will have the core components of a trend-following trading system, and be on your way to having your edge. 1. How does the system know what to buy or sell? 2. How does the system know how much to buy or sell? 3. How does the system buy or sell short? 4. How does the system get out of a losing position? 5. How does the system get out of a winning position? These 5 questions are seminal to trend following, but no less important is attitude. Don't forget, what do you want? Why are you trading? What are your strengths and weaknesses? Do you have any emotional issues? How disciplined are you? Are you easily convinced? How confident are you in yourself? How confident are you in your system? How much risk can you handle? When I discussed trading with Ed Seykota and Charles Faulkner, they both said the first step any person should take before trading is to complete a personal inventory. What is my nature, and how well am I suited to trading? How much money do I want to make? What level of effort am I willing to make to reach my goals? What, if any, is my investing/trading experience? What resources can I bring to bear? What are my strengths and weaknesses? Answering these questions is mandatory for when you are in the middle of the zero-sum game and adrenaline and sweat are flowing heavy. You can't afford to blink when chaos hits. What do you buy or sell? Will you trade stocks, currencies, futures, commodities? What markets will you choose? While some people might focus on limited, market-specific portfolios, such as currencies or bonds, others pursue a more widely diversified portfolio of markets. For example, the AHL Diversified Program, the largest trend-following fund in the world, now run by Man Financial, trades a diversified portfolio of over 100 core markets on 36 exchanges. They trade stock indices, bonds, currencies, short-term interest rates, and commodities. For example, energies, metals, and agriculturals. Table 10.1, AHL Portfolio. Currencies, 24.3%. Bonds, 19.8%. Energies, 19.2%. Stocks, 15.1%. Interest rates, 8.5%. Metals, 8.2%. Agriculturals, 4.9%. AHL does not have fundamental expertise. No trend-following trader keeps fundamental experts on staff. They do not have an in-depth understanding of the companies that comprise whatever stock index. Their expertise is to take these different markets and make them the same through price analysis. When you look at trend-following performance, losses are offset by winners. No one ever knows which market will be the big trend that pays for the losses, hence the need for diversification. AHL is even more precise about diversification. The cornerstone of the AHL investment philosophy is that financial markets experience persistent anomalies or inefficiencies in the form of price trends. Trends are a manifestation of serial correlation in financial markets, the phenomenon whereby past price movements inform about future price behavior. Serial correlation can be explained by factors as obvious as crowd behavior, as well as more subtle factors, such as varying levels of information among different market participants. Although they vary in their intensity, duration, and frequency, price trends are universally recurrent across all sectors and markets. Trends are an attractive focus for active trading styles applied across a diverse range of global markets. You can see AHL's words perform in practice by how another trend-following trader described diversification. Portfolio diversification is often said to lose its importance after you have 7 to 10 different instruments in your portfolio. We found this simply not to be the case. Pre-June 2007, we traded with 18 major markets in the program, and we were in 7 to 8 of them most of the time. In short, our exposure was 7 to 8 markets at any one time, while signals in 18 were possible. After evaluating the program, we discovered that most of our losses, at the time, were coming from 1 or 2 sectors that hit their maximum loss at roughly the same time. A breakout in the 10-year notes was most likely followed by a breakout in the 5-year notes. Trading several highly correlated markets had led to exaggerated losses because these markets triggered a larger drawdown as they were stopped out together. He increased his portfolio to over 40 markets with the goal of being in 15-plus markets most of the time. And he still left his core trading system, entry and exits, the same. The turnaround in results was dramatic, all from changing the portfolio diversification. Paul Mulvaney, for example, made over 40% in October 2008 alone. His performance was generated from these markets. Currency, 8.91%. Interest rates, 2.78%. Stocks, 14.59%. Metals, 9.83%. Energy, 3.43%. Crops, 7.84%. Livestock, 4.51%. Yes, that is one great outlier month. All months and sectors will not always be positive, clearly. But Mulvaney's performance during one of the worst months ever is a wake-up call to trend-following possibilities. After all, author and film star Ben Stein famously said if you made money in October 2008, you were doing something wrong. Now, fast forward 8 years. On June 23, 2016, 51.9% of the United Kingdom voted to exit the European Union. Most prognosticators were surprised, if not shocked. Mulvaney's performance was 17% on June 24th. His one-day Brexit performance, his greatest one-day return in the history of his firm, is a fantastic illustration of being on the right side of surprise. Longtime trend-following trader Robert Rotella adds, "Qualitative examination of price movements suggests that markets were trending in the direction of the Brexit exit in the prior months. This is supported by systematic analysis over the same period." There is never one perfect portfolio composition that will capture the next trend. Many trade different portfolios for untold different reasons. Generally speaking, trend followers trade the same markets. However, although larger trend-following funds might avoid smaller markets, such as pork bellies or orange juice, other trend-following traders might trade currency or bond-only portfolios. Salem Abraham, for example, once made a killing off cattle. Whatever markets chosen to trade, remain open to opportunity when it arrives. Author Tom Friedman makes the strong argument for sound strategy in a complex world. If you can't see the world, and you can't see the interactions that are shaping the world, you cannot strategize about the world. And if you are going to deal with a system as complex and brutal as globalization and prosper within it, you need a strategy for how to choose prosperity for your country or company. Friedman knows all too well the real power brokers in today's frighteningly interconnected world are traders, not politicians. How much do you buy or sell? The question many avoid at all costs is the question of money management, also called risk management, position sizing, or bet sizing. It is a critical component to trend-following success. As Gibbons Burke observes, "Money management is like sex. Everyone does it, one way or another, but not many like to talk about it, and some do it better than others. When any trader makes a decision to buy or sell short, they must also decide at that time how many shares or contracts to buy or sell. The order form on every brokerage page has a blank spot where the size of the order is specified. The essence of risk management is making a logical decision about how much to buy or sell when you fill in this blank. This decision determines the risk of the trade. Accept too much risk, and you increase the odds that you will go bust. Take too little risk, and you will not be rewarded in sufficient quantity to beat the transaction costs and the overhead of your efforts. Good money management practice is about finding the sweet spot between these undesirable extremes. I've only got a certain amount of money. How much do I trade? If you have $100,000 and you want to trade Microsoft, well, how much of your $100,000 will you trade on Microsoft on your first trade? Will you trade all $100,000? What if you're wrong? What if you're wrong in a big way and you lose your entire $100,000 on one bet? Trend following, by design, makes small bet sizes initially. So if you start at $100,000 and you're going to risk 2%, that equals $2,000. You might say to yourself, I've got $100,000. Why am I only risking $2,000? What's the deal? I've got $100,000. $2,000 is nothing. That's not the point. You can't predict where the trend will go. You don't know up or down. One trader's view on the initial risk decision. There are traders who are unwilling to risk more than 1%, but I would find it surprising to hear of any trader who risks more than 5% of assets per trade. Bear in mind, risking too little doesn't give the market the opportunity to allow your profitable trade to occur. Think about money management as getting physically fit. Let's say you're a male athlete and you want peak performance. You weigh 185 pounds, 84 kilograms, and you're 6'1", 185 centimeters. Well, guess what? You can't lift weights 6 times a day for 12 hours a day for 30 straight days without hurting yourself during those 30 days. There's an optimum amount of lifting you can do in a day that gets you ahead without setting you back. You want to be at that optimal point, just as you want to get to an optimal point with money management. Ed Seykota describes that optimal point with the concept of heat. Placing a trade with a predetermined stop-loss point can be compared to placing a bet. The more money risked, the larger the bet. Conservative betting produces conservative performance, while bold betting leads to spectacular ruin. A bold trader placing large bets feels pressure or heat from the volatility of the portfolio. A hot portfolio keeps more at risk than does a cold one. Portfolio heat seems to be associated with personality preference. Bold traders prefer and are able to take more heat, while more conservative traders generally avoid the circumstances that give rise to heat. In portfolio management, we call the distributed bet size the heat of the portfolio. A diversified portfolio risking 2% on each of 5 instruments has a total heat of 10%, as does a portfolio risking 5% on each of 2 instruments. A student of Ed Secoda adds, "There has to be some governor so I don't end up with a whole lot of risk. The size of the bet is small, around 2%. Secoda calls his risk-adjusted equity core equity, and the risk tolerance percentage heat. Heat can be turned up or down to suit the trader's pain tolerance. As the heat gets higher, so do the gains, but only up to a point. Past that point, more heat starts to reduce the gain. Traders must be able to select a heat level where they are comfortable. Do you trade the same with $100,000 as you would $200,000? What if your $100,000 goes to $75,000? Tom Basso knows many traders usually begin trading small, say with 1 contract, and as they get more confident they might increase to 10 contracts. Eventually they attain a comfort level of 100 or 1,000 contracts where they may stay. Basso counsels against this. He stresses the goal is to keep things on constant leverage. His method of calculating the number of contracts to trade keeps him trading the same way even as equity increases or decreases. One of the reasons traders don't trade proportionally as capital increases is fear. Although it might feel comfortable when the math dictates you trade a certain number of shares or contracts at $50,000, when the math dictates trade a certain amount at $500,000, you might become risk-averse. So instead of trading the optimal amount at whatever capital you have, some trade less. This can be avoided by creating an abstract money world. Don't think about what money can buy. Look at numbers like when playing Monopoly or Risk. Dunn Capital speaks to the money as a way to keep score perspective. Part of Dunn's approach is adjusting trading positions to the amount of equity under management. He says if his portfolio suffers a major drawdown, he adjusts positions to the new equity level. Unfortunately, he says, not enough traders follow this rather simple strategy. If you start with $100,000 and you lose $25,000, you obviously now have $75,000. You must make your trading decisions off $75,000, not $100,000. You don't have $100,000 anymore. However, Paul Mulvaney felt I was missing a critical aspect in money management. Trend following is implicitly about dynamic rebalancing, which is why successful traders appear fearless. Many hedge fund methodologies make risk management a separate endeavor. In trend following, it is part of the internal logic of the investment process. When do you buy or sell? When do I buy? When do I sell? These are the questions that keep investors and traders up at night. Yet there is no reason why the buy and sell process should be a melodrama. Obsessing about when to buy or sell keeps your limited time focused on things you can't control. For example, Apple has been trading between 100 and 120 for 6 months. All of a sudden, Apple jumps or breaks out to a price level of 130. That type of upward movement from a range is an entry trigger for trend-following strategy. They think, I might not know that Apple is going to continue upward, but it's been going sideways for a while, and all of a sudden, the price has jumped to 130. I'm not in this game to try and find bargains or cheap places to buy. I'm in this game to follow trends, and the trend is up. One trend trader outlined the simplicity. As our systems are designed to send a buy or sell signal only when a clear trend develops, by definition, we never get in at the beginning of a trend or get out at the top. If your goal is to ride a trend that starts at 50 and goes up to 100, it does not make a difference whether you got in at 52 or 60 or 70. Even if you got in at 70 and the trend went up to 100, you still made a lot. Now, if you got in at 52, and how you think you might predict the bottom I will never know, you made more money than if you got in at 70. There are plenty of traders out there who think, "Oh, I couldn't get in at 52, so I won't get in at all, even if I have the chance to get in at 70. Richard Dennis smacks that thinking. Any time the market goes up a reasonable amount, say a strong day's work, after you've put on a position, it's probably worth adding to that position. I wouldn't want to wait for a retracement. That is everyone's favorite technique, to buy something strong that retraces. I don't see any justification in the statistics for that. When beans are at $8 and go to $9, if the choice is to buy them at $9 or buy them if they retrace to $8.80, I'd rather buy them at $9. They may never retrace to $8.80. Statistics would show that you make more money buying them and not waiting for a retracement. Even if people are somewhat familiar with Dennis's approach to trend trading, they still love the entry obsession, a misdirection of energy and focus. Sakota deadpanned, "The entry is a big concern before it happens, a small concern thereafter." He is saying after you are in the trade, entry price isn't important. You have no idea how high the market is going to go or not. You should be concerned about protecting your downside in case the market goes against you, as opposed to creating drama associated with the perfect entry. After all, trend-following trades can last extended time frames. Positions held for 2 to 4 months are not unusual, and some have been held for more than 1 year, says a spokesman. Historically, only 30 to 40% of trades have been profitable. The words of the great baseball player Ted Williams immediately come to mind. "Hitting a baseball, I've said it 1,000 times, is the single most difficult thing to do in sport. If Joe Montana or Dan Marino completed 3 of every 10 passes they attempted, they would be ex-professional quarterbacks. If Larry Bird or Magic Johnson made 3 of every 10 shots they took, coaches would take the basketball away from them." How is it possible to make money with only 40% winners? Trend-following firm Campbell & Company is clear. Say, for example, on the 60% you lose 1% of your capital, but on the 40% winning trades you make 2%. Over longer periods of time, say a year or more, this would net 20% on a broadly diversified program. Trend-following rules to enter and exit are driven by what is commonly called technical indicators. The technical indicator for trend-following strategy is price action, that is, breakout, moving average, etc. However, many remain preoccupied with the hundreds upon hundreds of other indicators that promise prediction. They debate nonstop which is better, always assuming there must be something better. And they always yell at me that I didn't provide them the secret. Technical indicators, however, are small components of the overall trading system. They are some of the tools needed in the trading toolkit, but not the kit itself. A technical indicator accounts for maybe 10% of the overall trading success. When some trader opines, "I tried indicator X and found it was worthless," or "I tried indicator Y and found it useful," that makes no sense. These statements imply an indicator is the actual trading system. By itself, a technical indicator is meaningless. That means the suits that come on CNBC every week to talk technicals are meaningless? Yes. When do you get out of a loser? The time to think most clearly about why and when to exit is before getting in. In any trading system, the most important thing is to preserve your capital. A preset sell strategy gives you opportunity to not only preserve capital, but also redeploy into more opportune markets. When do trend traders get out of a losing position? Fast. This is fundamental to trend following. The logic of cutting losses and then cutting them even more has been around far longer than trend following. As Bernard Baruch notes, "If a speculator is correct half of the time, he is hitting a good average. Even being right 3 or 4 times out of 10 should yield a person a fortune if he has the sense to cut his losses quickly on the ventures where he is wrong." For example, you enter GOOG with a 2% stop loss. This means if you lose 2%, you exit. Period. Get out. Don't debate it. Look back at the British pound trade in my Chapter 2 Dunn profile. That chart, see Figure 2.3 in the supplemental PDF, shows the constant starts and stops. Dunn keeps receiving entry signals and then exit signals. The trend is up and then it is down. He enters and then exits. Dunn knows he can't predict the direction of the British pound. He only knows he has received an entry signal, so he gets on board. Then he receives an exit right after that, so he gets out. Then another entry signal, then another exit. Dunn did say he rides the bucking bronco. Traders call these back-and-forth swings whipsaws. Whipsaws are quick ups and downs that go nowhere. Your trade is jerked or whipsawed back and forth, causing small losses due to lack of sustained trends. Sakota says the only way to avoid whipsaws is to stop trading. See his Whipsaw song on YouTube. Whipsaws are part of the game. Don't want to live with them? Don't trade. An old pro trader sent in a great story about his days at trend-following incubator Commodities Corporation that makes the point. Back in the early 90s, Commodities Corporation, CC, brought a few Japanese traders in for some in-house training. Of course, the ultimate and true goal was to capture some big Japanese money. I was still in their good graces, and CC asked me to have lunch with a couple of these gentlemen. They were new to the program, and I hoped to give them some insight into how I handled the process of trading. I told them they had to come up with a method or system that fitted who they were. Then I told them I thought it was great to find a mentor, and I was available anytime they had questions or issues, and that is still me today. I then began to discuss how important risk management was, and that I was willing at that time to risk only 1% per bet in dealing with public money. I am more aggressive today, but that was then. I told them that losses were part of the process in finding winners. I will never forget as long as I live the youngest trader looked me square in the eye and with a very puzzled look asked, "You have losses?" I knew right then these birds had a very long way to go, and I often wondered what happened to them. Guaranteed that young trader moved into another profession. When do you get out of a winner? You have seen the headline hype. Use Japanese candlesticks to spot reversals, or determine support and resistance, or learn proper profit-taking. Stop. You can't spot reversals until they happen. There is no way to define the concept of support and resistance as 100 people could have 100 different definitions. These directions all try to do the impossible, predict. Tom Basso slams profit objectives. A new trader approaches an old trend follower and asks, "What's your objective on this trade?" The old trend follower replies that his objective is for the position to go to the moon. Exiting a winning position can be a challenge because you have to be comfortable with letting a trend run as far as it can, crest, and then begin to decline before considering an exit with profits. Say you are up 100% in paper profits. If you cash in, those paper profits become real. But you have made a big mistake because you limited yourself in how much you could make. If you are long several positions and there are huge open profits on the table and the trend is still up, that is not the time to get out of a winner. Profit targets cap profits. For example, you enter at 100, and before you ever enter, you establish you will exit if the price reaches a 25% gain or 125. The idea of a profit target sounds wise at first blush. However, if you are riding a trend, you have to let it go as far as it can go. You need to fully exploit the move. You don't want to exit at 125 and watch the trend go to 225. Although profit targets keep you from getting to 225, they also play a damaging role in the overall trend-following portfolio. Trend following needs those home runs to pay for its whipsaw losses. If you are artificially creating a profit target for no other reason than comfort, you are limiting potential for big trends. This, in turn, limits the ability to cover the small losses you've incurred. If you had used profit targets, there is no way you would have been around to win the huge profits from the events described in Chapter 4. Trend-following profits come from the meat or middle of a trend. See Figure 10.1 in the supplemental PDF. Your trading system. When you mechanize a trend-following trading system, you take all discretionary judgments and build them into rules. For example, if you are uncomfortable with a high level of risk, you make a rule that sets a tolerable risk level. If you trade a currency-only portfolio, you make rules for that contingency from the outset. The logic is to hardwire all scenarios you could possibly see in advance across your portfolio. If a market rises 100% in short order, you have rules that dictate the action to take. If a market loses 10%, follow the rules. You must have an unambiguous plan established in advance. It also helps to constantly be aware of the downside. Larry Hite gives that legendary Stoic perspective. We approach markets backwards. The first thing we ask is not what we can make, but how much can we lose. We play a defensive game. Frequently asked questions. Fact 1. Starting capital. Ed Seykota was once asked how much money someone should have before starting to trade. He responded, "Good money management is equity invariant. I'd ask a trader who thinks he needs a certain amount before he can trade exactly what amount he would need to stop trading. There is no dollar amount too little or too big that allows you to sit back and assume your starting capital alone is the secret." Numerous factors related to starting capital exist, not least of which is the personal discipline and ability to stick with it. Anyone who promises a certain amount of starting capital needed to win is full of it. However, what if you have unlimited resources? Rich can be a benefit or strike against you. Jaromir Jagr, the famous hockey player, and trend trader William Eckhart have polar views on starting capital. Jagr is the riverboat gambler. He doesn't play the stock market, but romps through it. Last year, published reports estimated he took a loss, of anywhere from $8 million to $20 million in the dot-com market. He doesn't just have a girlfriend who is pretty and bright. He has a girlfriend who is former Miss Slovakia and a second-year law student. Jagr might be a great hockey player, but his approach is straight to the poorhouse. Backed by the millions he made playing hockey, Jagr is the trader Eckhart avoided. I know of a few multimillionaires who started trading with inherited wealth. In each case, they lost it all because they didn't feel the pain when they were losing. In those formative first years of trading, they felt they could afford to lose. You're much better off going into the market on a shoestring, feeling that you can't afford to lose. I'd rather bet on somebody starting out with a few $1,000s than on somebody who came in with millions. Consider net worth examples of trend-following traders that started as one-man shops. Bruce Kovner is worth over $5.3 billion. John W. Henry is worth $2.1 billion. He used his trend-following gains to buy the Boston Red Sox for $700 million. Bill Dunn made $80 million in 2008 when the rest of the world was blowing up. Michael Marcus turned an initial $30,000 into $80 million. He also taught Bruce Kovner. Marcus was a student of Ed Seykota's. David Harding is worth over $1.387 billion. Kenneth Tropin made $120 million in 2008 as buy and hold collapsed. Earlier in his career, he led John W. Henry's firm. That is inspirational. A small fraction of those huge fortunes is motivating, if you still have a pulse. Fact 2. Trend following for stocks. One of the great myths about trend following is it does not work on stocks. This is 100% false. Trends in stocks are no different than trends in currencies, commodities, or futures. Jerry Parker's trend-following firm, for example, has adapted its system to stock trading, and he is not alone. For example, David Harding. He notes his system works well with stocks, particularly stocks and outlier moves that are in single industries. Bruce Terry, a disciple of Richard Donchian, dismisses out of hand the not-for-stocks meme. Originally in the 1950s, technical models came out of studying stocks. Commodity Trading Advisors, CTA, applied these to futures. In the late 1970s and early 1980s, stocks were quiet and futures markets took off. That is how the CTA market started. It has come full circle. people are beginning to apply these models to stocks once again. From my Leave No Stone Unturned research, I am reminded of the opening line I found in the Managed Accounts Reports article from 1979. Trading stocks and commodity futures by means of trend-following techniques is an art with a long history. Fact 3. Computers and curve fitting. Larry Hite knows a computer can't get up on the wrong side of the bed in the morning, which is why computers handle his decision-making and implementation of his trading rules. If your boyfriend or girlfriend breaks up with you, you'll feel one way. If you get engaged, you'll feel another way. Hite would much rather have one smart guy working on a lone Macintosh than a team of well-paid timekeepers with an army of supercomputers. At the same time, however, Hite is adamant the real key to using computers successfully is the thinking that goes into the computer code. When someone asked him why go the computer route when people power is so important, he replied, "Because it works. It's countable and replicable. I'm a great fan of the scientific method. And the other things are not scientific. If I give you the algorithms, you should be able to get the same results I did. That to me means a great deal." However, technology can over-optimize or curve-fit a trading system to produce something that looks great on paper alone. Barbara Dixon, a Donchian student, notes, "When designing a system, I believe it's important to construct a set of rules that fit more like a mitten than like a glove. On the one hand, markets move in trends. But on the other hand, past results are not necessarily indicative of future performance. If you design a set of rules that fit the curve of your test data too perfectly, you run an enormous risk that it will fizzle under different future conditions. A robust trading system, one that is not curve-fit, must ideally trade all markets at all times in all conditions. Trend-following parameters or rules must work across a range of values. System parameters that work over a range of values are considered robust. If the parameters of a system are slightly changed and the performance adjusts drastically, beware. For example, if a system works great at 20 but does not work at 19 or 21, that system is not robust. On the other hand, if a system parameter is 50 and it also works at 40 or 60, the system is much more robust and reliable. Trend trader David Drews has long championed robustness in trading systems. He dismisses trades of short-term traders who fight for quick-hitting, arbitrage-style profits as pure noise. Traders who focus on short-term trading often miss the longer-term trends, those trends where long-term trend following often bags its biggest opportunities. To wait like that, you need complete faith in your trading system. However, you are in serious trouble if all you think you need to succeed at trading is the latest hardware and software. As Barbara Dixon warns, contemporary databases, software, and hardware allow system developers to test thousands of ideas almost instantaneously. I caution these people about the perils of curve fitting. I urge them to remember one of their primary goals is to achieve discipline, which will enable them to earn profits. With so many great tools, it's easy to change or modify a system and to develop indicators rather than rules. But is it always wise? It is easy to get caught up in the computer program hype. Advertisements run nonstop everywhere, promising instant riches. Fancy charting software will make you feel like master of the universe, but that is false security. When describing his early trading successes, John W. Henry made it clear it was philosophy, not technology. In those days, there were no personal computers beyond the Apple. There were few, if any, flexible software packages available. These machines, far from being the ubiquitous tool seen everywhere in the world of finance and the world at large today, were the provinces of computer nerds. I set out to design a system for trading commodities, but things changed quickly and radically as soon as I started trading. My trading program, however, did not change at all. As I said, it hasn't changed even to this day. One of Henry's longtime associates elaborated. Originally, all of our testing was done mechanically with pencil and graph that turned into Lotus spreadsheets, which was still used extensively in a lot of our day-to-day work. With the advent of some of these new modeling systems like System Writer, Day Trader, and some of the other things, we've been able to model some of our systems on these products, mostly just to backtest what we already knew, that trend following works. Tom Basso clarifies, "You'll find that the more you're computerized, the more markets you'll be able to handle. Computers leverage your time if you know how to use them." And Richard Donchian makes clear the time needed to execute successfully as a trend-following trader. If you trade on a definite trend-following, loss-limiting method, you can trade without taking a great deal of time from your regular business day. Because action is taken only when certain evidence is registered, you can spend a minute or two per market in the evening checking up on whether action-taking evidence is apparent, and then in one telephone call in the morning, place or change any orders in accord with what is indicated. Furthermore, a definite method, which at all times includes precise criteria for closing out one's losing trades promptly, avoids emotionally unnerving indecision. The minute or two Donchian refers to takes preparation time. After you test your system and are satisfied with results enough to begin trading, the work is still not done. System results must be periodically compared to actual results to ensure that testing closely reflects real time. It is also helpful to keep a journal to record how well you stick to executing your system. One trend trader trained at Commodities Corporation told me, "Early in my trading career, I found myself hung up on the need to be right rather than the desire to make money. I learned early that being right, of having a high percentage of winners, had very little to do with my overall trading success. Those who have a need to be right with a high percentage of winners will find themselves passing on their best trading opportunities, assuming they use some degree of discretion in their trading selections. One of my trading buddies enjoys a trading success rate annually of around 15% winners, with 50% losers and 35% break-even trades. In 2005, he made over 300% on his initial beginning-of-year trading capital of a seven-figure account. This is a risk-reward numbers game, and most who think it is something else usually face a forced awareness at some point in their trading careers. To further emphasize my point, everyone has seen ads on the internet for systems being promoted at 90% accuracy. I bet 3/4 of these systems are based on a set of past criteria that have very little to do with their future performance. Let's say you do 100 trades in a calendar year. The average winning trade makes a net $100, so you make a net $9,000 in the winners. Now the bad news is the 10 losing trades are for $1,000, so you lose a total of $1,000 for the year in a system that had 90% winners. Now, I realize this is a stretch from reality, but mathematically this is what happens once a trader commits capital to the so-called sure-thing trading systems. Trend-following legend Ken Tropin was even more specific. In order for a system to be successful, it has to be what I call robust. Robust means I can test that system in a market I designed it around. Say I'm using it in the Treasury bonds, and then if I switch that market and try that system in the euro, it still works. And if I change its parameters, it still works. And if I switch it over to corn, something totally different than Treasury bonds, it still works. And if I look at some data that was out of sample from what I designed it around, it still works. Then I have something that might be interesting and have a chance of living in the future. Because the nature of data is it changes a little all the time. And so the key to success in systems trading is to have what I call a loose-fitting suit. I can't have a suit that's so tight and perfectly proportioned to me that if I gain 2 pounds, it won't fit the data anymore. Andrew Lo of MIT brings it back to simplicity. The first rule of thumb being that no matter how complex and subtle a strategy is, and no matter how sophisticated it might be, it has to be possible to describe that strategy in relatively simple and intuitive terms to a sophisticated investor. In other words, regardless of how subtle and impressive and sophisticated the strategy is, I've never come across anything that couldn't be described in relatively straightforward terms as to what the value added of that strategy was. Fact 4. Day trading limits. When you trade with higher frequency, the profit you earn per trade decreases while transaction costs stay the same. This is not a winning strategy. However, many traders believe that short-term trading is less risky. Short-term trading, by definition, is not less risky, as evidenced by the catastrophic blowouts of Victor Niederhofer and Long-Term Capital Management, LTCM. Do some short-term traders excel? Yes. However, think about the likes of whom you might be competing with when you are trading short-term, such as Jim Simons and Toby Crabble. Professional short-term traders, the HFT guys, have hundreds of staffers working as a team 24/7. They are playing for keeps and looking to eat your lunch in the zero-sum world. You don't stand a chance, Mr. Day Trading Dreamer. But day trading flaws are invisible to many. Sumner Redstone, billionaire CEO of Viacom, talked of constantly watching Viacom's stock price hour after hour, day after day. Although Redstone is a brilliant entrepreneur and has built one of the great media companies, his obsession with share price is pointless. Redstone might see his company as undervalued, but staring at the screen will not boost it. Fact 5. Wrong way to view a trade. Leo Melamed is Chairman Emeritus to the CME, episode number 265 on my podcast. He is recognized as the founding father of financial futures. He was named to the top 10 most important Chicagoans in business of the 20th century. Yet with this tremendous resume and success, he is clearly not a trend-following trader. The Hunt Silver debacle also provided the setting for my worst trade. My company partner George Fawcett and I had become bullish on silver beginning in June 1978, when it was trading around $5 an ounce level. We were right in the market, and silver prices moved higher. In September 1979, silver reached the high price of $15 an ounce, and the profit we were each carrying was substantial. George and I had never before made that kind of money. It was truly a killing. How much higher would silver go? Wasn't it time to take the profit? Large profits, as I learned, were even more difficult to handle than large losses. I had a very good friend, with special expertise in the precious metals markets. Since he knew I was long silver, I ventured to ask him his opinion. "Well, Leo," he responded, "you have done very well with your silver position, and I really can't predict how much higher silver will go. But I'll tell you this, at $15, it is very expensive. On the basis of historical values, silver just doesn't warrant much higher prices." I never doubted that he gave me his honest and best opinion. I transmitted this information to George, and we decided that if nothing happened by the end of the week, we would liquidate our positions and take our profits. That's exactly what we did. This was in late October 1979. So why was this my worst trade when in fact it was the biggest profit I had ever made up to that time? Because within 30 days after we got out of our position, the Hunt Silver Corner took hold. It did not stop going higher until it hit $50 an ounce in January 1980. George and I had been long silver for nearly 2 years, and had we stayed with our position for just another 30 days, we would have been forced to take a huge profit. We both vowed never to calculate how many millions we left on the table. I can see why his 1979 silver trade was his worst trade. He described no predefined entry criteria. He never gives a reason why he and his partner were bullish on silver in 1978, nor does he explain why he entered the silver market other than it was at such a low price, $5. When the price of silver started to increase, he attempted to find out how high it would go, which is impossible. However, because he had no clearly defined exit rationale, he was uncertain when to get out. Without an exit strategy, Melamed fell back on conventional trading wisdom that buying higher highs is wrong. He attempted to use fundamentals to justify that silver would not continue to increase, and then set a profit target to get out. By having a profit target instead of an exit plan, Melamed lost out on millions of dollars of profit. Now, he has had a fantastic career, but his trade example contrasts sharply with trend following. Rob Romaine brings it back to preparation. The value of a disciplined trading systems approach is that it allows you to design your strategy during non-stressful times. Then, when the markets are tough, you need only to execute your plan rather than being forced to face difficult decisions under pressure when you are most likely to make mistakes. Let me state emphatically the big picture point. If you are sitting in front of 20 monitors pretending to be master of the universe, like Bobby Axelrod in Billions, and imagining you can watch all those screens simultaneously and react cat-quick to thousands of pieces of real-time data? Give me a break. You can't, even though this guy, seen in the picture in the supplemental PDF, would argue vociferously for his supernatural monitor scanning skills. Summary food for thought. Money is how you keep score. Ewan Kirk. Have we changed things on the basis of what happened? The answer is no. We did not lose the faith. We are always grounded in research and coming up with new ideas. If a model is losing money, but is within the statistical expectation, you can't just chop and change everything because you have a period of poorer performance. Paul Tudor Jones. I teach an undergrad class at the University of Virginia, and I tell my students, I'm going to save you from going to business school. Here, you're getting $100,000 class, and I'm going to give it to you in 2 thoughts, okay? You don't need to go to business school. You've only got to remember 2 things. The first is, you always want to be with whatever the predominant trend is. You don't ever want to be a contrarian investor. Larry Tentarelli. My biggest winners over time have come from 2 signals: crossing over 200 SMA and new 52-week highs. That's it. Josh Hawes and Paul King. The 4 ways to make money trading: making money when price moves, making money when price does not move, arbitrage, market making/scalping/high-frequency trading. Seth Godin. If someone needs direction, don't give them a globe. It'll merely waste their time. But if someone needs to understand the way things are, don't give them a map. They don't need directions. They need to see the big picture. Leo Tolstoy. The 2 most powerful warriors are patience and time.
I've never had an epilogue in a book before this, and I really enjoyed putting this together, especially for 2 particular pieces of information. I really enjoyed weaving in David Harding, the trend follower David Harding. I really enjoyed weaving in his comments on spreadsheets, along with Dan Dennett and his explanations as to how a computer works. I thought those were 2 spectacularly insightful perspectives from 2 brilliant guys. Without further delay, my epilogue for my book, Trend Following.
Epilogue. If a problem can be solved at all, to understand it and to know what to do about it are the same thing. On the other hand, doing something about a problem which you do not understand is like trying to clear away darkness by thrusting it aside with your hands. When light is brought, the darkness vanishes at once. Alan Watts. Books are never finished. They are merely abandoned. Oscar Wilde. The truth is, you can't rely on anyone but yourself to make your possible fortune or prepare for a comfortable retirement. The safest, most profitable way to prepare for your future is by following the trend, not following some talking head's opinion or your momentary emotional whim. Everything else beyond trend is white noise. For example, think about the next Fed meeting, as there is always a next. And you know the drill. Expect sophisticated talk from fill in the blank with the name of odd-looking economist that now leads the Fed, about this or that data, economic indicators by the bushel, assorted, indecipherable mumblings, and an army of TV talking heads lapping it all up as if an economic god has arrived. Let me be blunt. No politician or economist will fix anything for you. However, you can fix your own situation, or at least put much better odds on your side. You can get ahead and ultimately leave nonsense behind, that is, Fed watching. Look, nothing is easy, but the sooner you get off the passive investing train, the government promises merry-go-round, the sooner you can find peace of mind and possibly real money. Imagine decades into the future to visualize interest income. You can't. And like it or not, your Social Security benefits, or pension if you have one, will be cut big time. Or you'll be working well into your 80s. Or both? Don't make it to your 80s? Well, that's arguably the state's real plan for your golden years. But what if I'm dead wrong? What if I'm overly pessimistic? I could be, sure. Anyone can be wrong about future market events, especially when trying to analyze a financially engineered landscape going back to Netscape's 1995 IPO. That leaves us with a conundrum. If we don't know what is coming next, how can we prepare for what's coming next? That is why trend following can't be ignored. Sometimes in trying to make a case, I stumble into that perfect story that makes me smile. At the end of a 2016 presentation, I blurted out what must have sounded like an unexpected sign-off to the audience. Pray for trends. One of my associates got a kick out of that. He needled me, and at first I felt silly for invoking a religious ritual as a possible path to profit. Let me be clear. That's not how trend following works. And I did not mean to push prayer as strategy, but concluding with that sign-off, being very clear that none of us have control over the markets, letting go was my point bubbling up from my subconscious. Letting go in the form of trend-following philosophy can be summarized: no one can predict the future. If you can take the would-be, could-be, should-be out of life and look at what actually is, you have a big advantage over most. What matters can be measured, so keep refining your measurements. You don't need to know when something will happen to know it will. Prices can only move up, down, or sideways. Losses are a life, and there is only now. That's a more complete explanation than my call for prayer. But I know that some become upset at those 7 points. They see them as trite. Too simple. They're not complex enough. There must be more. Covel is El Diablo. Look, even with the evidence supplied in trend following, there will be those who cry for the secret, or alternatively bemoan me, the messenger, not the message. After 13 years of living this work, confusion, critics, skeptics, and trolls abound. It's expected. A shatter the earth is flat point of view such as this book will leave many in cognitive dissonance, because if trend following makes you feel not so smart, not so wise, then it will be hard to accept if your self-image is PhD brilliant. There are still others who will never cross the Rubicon, even if they half believe and half want to try. Yet indecision won't work. It's the reason why behaviorists like Daniel Kahneman are as important to trend-following understanding as the system math. It's all in, or you definitely won't make it. But even if you have the right approach, you better have patience too. Altegris, an investment firm based in La Jolla, California, has placed over $1 billion with trend-following traders like David Harding, Ewan Kirk, and William Eckhart. I spent some time with the founder of Altegris, John Sundt. He put forth a conundrum. Can a great trader have great skill and no opportunity to make money? Can a bad trader have no skill and tons of opportunity to make money? The answer is yes to both questions. Luck is at play in the short term for most traders. There will always be some guy with a great one-year return, but the sustained edge appears only over time. What happens when the bad trader with no skill finally finds no opportunity? Know that answer or go to Vegas. And trust me, Vegas can be super fun, so there is a consolation prize if trend following is not your cup of tea. Oz behind the curtain. Believing in price alone will never be accepted by the masses, and the size of assets under management in passive index funds confirms that belief. Trend following is not a provocative enough narrative for investors raised on crystal balls and disingenuous media selling ads for brokers. On the other hand, if you want to avoid acute pain in your trading account when the next investment black plague rears its head, and avoid bleeding out, and if you are ready to disconnect from a state-sponsored feeding tube, then acceptance of price as the only fact is the starting and logical first step. Do that, and it becomes easy. You say, "No way, trend following is too complicated." Not true. Listen to David Harding's incredulity as he explains his early lack of computing sophistication. I had a very deep understanding of the ideas involved in running trend-following trading systems, and it was very easy for me to set up. As a matter of fact, we set it all up using spreadsheets. We didn't have any sophisticated computers. We had no computer languages. That revelation alone might cause the folks chasing secrets a myocardial infarction. But Harding was not done. In fact, we didn't employ any programmers at all. One of my old friends who has no training of any sort wrote all the systems and everything on a single spreadsheet, and we were able to run our firm just on a spreadsheet program in Excel with 3 people. That spreadsheet continued in operations the next 9 or 10 years. Laughter. I'm really letting the secrets out of the bag here. Maybe it was more than 10 years, but yes, 9 or 10 years. But I was able to run that very easily and didn't indeed have to work. We were creating a track record. He then went theoretical physicist on the deeper meaning at play within a trend-following philosophy. Trend following is much more profound than many hedge fund strategies because it's talking about the very exploitable effect in the price movements of whole asset classes. People talk about anomalies. It's not like some small anomaly. It's about the way the whole world works. It's a theory about the way the world works, which is different from the theory that everybody in the financial world has about how the world works. Daniel Dennett, a cognitive scientist with zero connection to trend following, compounds Harding's insights. Here is something we know with well-nigh perfect certainty. Nothing physically inexplicable plays a role in any computer program, no heretofore unimagined force fields, no mysterious quantum shenanigans, no élan vital. There is certainly no wonder tissue in any computer. We know exactly how the basic tasks are accomplished in computers and how they can be composed into more and more complex tasks, and we can explain these constructed competences with no residual mystery. So although the virtuosity of today's computers continues to amaze us, the computers themselves, as machines, are as mundane as can openers. Lots of prestidigitation, but no real magic. No real magic, indeed. I am under no illusions with trend following. There will always be critics and cheerleaders. There will always be controversy with an alternative money-making strategy. Religious versus atheist, Hatfields versus McCoys, Democrat versus Republican. Shoot, plain jealousy and envy. Those drivers will always have a seat at the table too. Nevertheless, beyond histrionics and misinformation, I find solace in the decades, even hundreds of years of trend-following performance numbers. That is the real story, the truth Wall Street can't accept, match, or wants buried because it casts considerable doubt on their real agenda. Typical commission business, regardless whether you make money or lose it all. You see, no matter how many agree or disagree with this content, the philosophy and rules, backed by positive performance numbers, especially from historic winning times like October 2008 and Brexit 2016, it paints a picture of Homo sapiens' money-making reality you accept or reject. While this is the 5th edition of trend following, it will not be the last. Some massive, unexpected surprise will unfold, some calamitous and unforeseen implosion where trend following makes a fortune so massive that politicians demand it be outlawed. And then I will need to get that trend into these pages post-haste before they lock me up for causing too many to see the light.
Again, if you enjoyed those 3 chapter samples, head on over to Audible, head on over to Amazon, pick up the full audiobook. And look, if you're not an audiobook person, I'm not really, to be honest with you. The hardcover for this book, for this trend following edition, my 5th edition, is spectacular. This book is one of those books you put on the shelf, guaranteed the grandkids get it. You don't throw it away. And that alone is a motivator. That alone is worth picking up a book. Hey, look, all my cheap, crass salesmanship stuff aside, I put a hell of a lot of time into this book. 220,000 words that you will not find compiled anywhere else. A perspective that, as I said at the beginning of this episode, is timeless. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.